Thank you all for coming. Really appreciate it. Would just like to start off introducing our crew, which is Michelle Blood, Ginger Belker, our newly minted MBA, Dominic Piazza, and Jeremy Brown. David Wild is here someplace. Where's David? There's David. David manages separate portfolios for his clients, does a great job. And if you have any questions for David during the meeting, just call him out and we'll get him a mic. We have an awesome, empowered, collaborative team. That's what we do for a living. I'd also like to thank the Ranch Club team here, the barn. We've got Brandy Hildebrand, Austin Faulkner, who left to go to a concert, but he prepared all the food tonight, Alex Love, and Delaney Crinning. And again, I re-emphasize, they too are an empowered, collaborative team. And we'll kind of get into those important terms maybe as we go along here. Just a little housekeeping to get started for particularly clients that have been with us a long period of time. We've had a stock, a company that we've owned. It's a pretty cool story actually, but we've owned it since 1988. And it's called the Rogers Corporation. Originally introduced to us by sort of a legend in the industry, a fellow by the name of Phil Fisher. And Rogers, after 30 some odd years, is getting bought out by DuPont this year, and that should settle sometime in July. And so the ramifications of this are that those of you that have owned it for a long period of time are going to have a fairly significant tax bite on this particular security. And so, and this is primarily, by the way, for the individually managed accounts and not the Tarkio fund. We've owned Rogers for an awful long time. They've had probably 5 different management changes over the last 35 years. They've taken a run at becoming a company that would be more aligned with our criteria several times and have kind of never really followed through. I would categorize Rogers as not the best company, the best managed company that we have in the portfolio. It's been a little frustrating for a few years. And DuPont has paid what I categorize as a very hefty price. They paid 5 times sales for the Rogers Corporation at $277 a share. And it's rarely sold for more than 2 times sales in the 35 years that we've owned it. So it was a very attractive price that they paid for it. The company itself, we were a little disenchanted with over the years. When you've owned something for 35 years, it's the fact of having a management team in place that year after year that would continuously be managed under the same criteria that we were interested would be a rare feat, although we have a couple of those. And so we kind of view the transaction as a gift from God in spite of the fact that it's going to cause some tax issues for folks. When they announced the buyout last year, the stock gets frozen, and so the buyout price is $277 a share. The stock's been hovering around $272. The transaction should be completed I'm assuming by the end of July. And so because the price got frozen and then the stock market in general declined after the announcement was made, it gave us the ability to sell off pieces of Rogers and to reallocate those funds into other companies as they were dropping. And we've been doing that with Rogers really since the first of the year. Obviously, we were a little early as always, but it really worked out. It couldn't have worked out better in our opinion. That we did transition a fair amount of stock into other companies. Those that are in taxable accounts, we've tried to hold enough back to pay your taxes. So we'll let you know when the transaction actually gets completed. And my opinion would be at that point in time, take the money out and send it to the IRS. Is there any questions on that? Yeah, we're definitely not lamenting this transaction, so. Next, the other event that's occurring is that, as you know, we use TD Ameritrade as our platform, and TD Ameritrade that we do all our trading and hold all the securities. TD Ameritrade is getting bought out by Schwab, and it's already actually caused some issues, particularly those that have had pension plans. Michelle has done an enormous, heroic amount of work to get these pension plans restructured to where it'll be accepted on the Schwab system. We apologize for the paperwork that you had to do and the additional anxiety that it might have caused. Pretty much have that completed. And that said, there's a couple of other issues that we foresee with the transaction that Michelle will comment on. There might be other stuff that we're not aware of, but just to let you know, we really have no choice to get all of you to, if we decided not to go with Schwab and to go with Fidelity or Interactive Brokers or somebody else, we would have to re-paperwork every single account that we have, which would be literally impossible. So we're captive, and we're just battling through whatever it is that the transaction is going to bring our way. And so,
Ameritrade brought the talking baby back.
What's that?
I said just when Ameritrade brought the talking baby back.
Yeah. Well, there's a whole slew of other ads for Schwab that we find equally as distasteful. So, but basically, it's just a platform. We've never viewed TD Ameritrade as a partner. We viewed it as a vendor, and as far as all the other alternatives out there, Schwab is fine. It just there's a few nuances with the transaction. The biggest one was the pension plans, and then I'll let Michelle comment on a couple of little additions that you're going to need to watch out for.
It looks like also maybe our battery isn't working on something over there.
Oh.
It's the charger.
It's a good thing that our IT company is here tonight.
Don't blame me for this.
Also, please everyone feel free, don't be shy, go up and eat as much of that spread as you can. As we're talking, feel free to get up and walk up and grab drinks or food. We won't hold it against you.
Yeah, go ahead.
So with the conversion, it was announced in November of 2019, and they said from the beginning it'd be about 3 years before they would actually get the whole conversion, because there's an awful lot of different pieces and parts they have to kind of match up, go back into the houses of each side. And so it looks like the transfer is gonna probably occur next year in September, August-September timeframe.
You will get, some of you have been through some of these conversions before, you will get two 1099s for 2023. So be aware of that, make sure you look for both of them. We're happy to help you get those as well. We can always get those to your accountants or to you. You will have a new account number. Big, kind of stinks, but their system just isn't set up for TD's numbers. We'll have kind of a comparison chart and stuff for all that. So if you ever need those numbers, we can definitely get those for you as well. They're going to be, Schwab communicates a lot. Sometimes it's too much, but if you have questions during this whole time, please call us. I think that's kind of it for now, but it's coming. And I'm sure there'll be things that we, like Russ said, we don't know about now, but supposedly they're not going to repaper the accounts, just some of the ones that Russ talked about where we had to do some of their retirement accounts. So. Questions?
Now, later on, we're going to need your questions, so start thinking about, and the tougher the better. So, yeah, Tom.
So normally, when you transfer an account, we'd have to have you open a Schwab new account form, a Schwab transfer form. You'd have to sign that, send it in, then the account would move. They're going to just move your accounts from TD to Schwab without paperwork. Oh. It'll be same registration, same banking information if we happen to move money to your bank for you. Everything would be the same. It's supposed to all
negative consent or something?
Yeah, they call it negative consent. You'll get a letter that says, you know, this is what we're going to do because of the merger, but.
Will the account numbers be the same?
No, they will change. Their system is a little different.
Any other questions on that transaction? Yeah, we had no, again.
I'm just wondering if the paperwork will come through the mail monthly, the way it does with TD and America.
Like your statement?
Yes.
Yeah, your statement will come. One of the things that they're trying to match up is anybody that gets their statements electronically, if you get it electronically and you are not set up on advisor client where you can go in and see your account online, they're going to start flipping that to paper statements. They want to get you all signed up on the advisor client website so that it moves over to Schwab they're really going to just the online access, online forms, everything online. So call the office, we can help you get set up. You can set yourself up. It's really pretty easy, but there are a few little obstacles with that. So just call us and we can help you.
Any other questions on that? Ginger, can we go to slide 3?
One more question.
Oh, yeah, Gary.
If we have other Schwab accounts, will they be co-linked?
No. No.
Joined anyway?
They will not. No, they'll be, our accounts are institutional accounts, and you might even have another account, let's say with another advisor that's an institutional, that'll stay with their firm, and all these accounts will go with our firm.
Are we good?
Yeah, I think so.
What do we got on the screen here? Something good?
Yeah, we got.
Okay.
You got the slides up.
So, given the recent volatility that we've had, I thought it was appropriate to revisit a piece of our, this is a piece of the introductory presentation that we give to all new prospective customers that come in. We call it the gauntlet that we run them through. And I know that all of you or most of you are going to find this redundant, and it is meant to be. So, what I'm going to try to explain for a minute here before we get into questions is start thinking about questions, and you can interrupt me in the middle of this too if you need to. So, but we're going to try to explain how the stock market doesn't work. That's okay with you. So we think to be successful, one has to identify what it is that they know. We think that's fairly important in any endeavor. But we think even more importantly than to understand what you do know is to have a clear, absolutely clear understanding between what you can know and what you cannot know. And we think the way you protect yourself from what you cannot know is to know everything you possibly can of what you can know. And never, ever override what you do know with what you don't know. And we think the vast majority of investors of all shapes and sizes and flavors make the vast majority of their decisions based upon a set of variables that has no predictive value whatsoever. None, zero, zilch. And in that category, we put all geopolitical and macroeconomic events. So pandemics and elections and a war in the Eastern Europe, the growth rate in China, Brexit, the list goes on and on and on and on. And our belief is that all of these things in total, that the equation has so many variables that the equation is completely unpredictable. However, we think the vast majority of investors make the vast majority of their decisions based upon changes in what we think are basically random events. And because of that, the stock market fluctuates violently based upon changes in these unpredictable events. And that turns it into sort of a strange place, actually. And because the fluctuations change so much based upon these events, that it draws even more people into that game because nobody wants to get washed around with the rest of the minions. And the bigger the pool of money that somebody's responsible for, particularly if they're a fiduciary, then it's their responsibility to hire somebody that can figure all this stuff out. And there's a whole ton of people out there with a big price tag that are willing to give their advice for a big price. And we think that they too don't know what they're doing. And then for those folks that have a higher IQ, that are blessed with a higher IQ, it's even more difficult for them because they think that they can move in and out and outsmart everybody in the short term, and they can't because it's a loser's game. So you get these wild fluctuations based upon a set of variables that we believe are totally random. Have any questions on that? And so if the process isn't confusing enough as it is, we'll make it a little more challenging. And that is that the stock market is a pari-mutuel system, meaning that it's like the racetrack. The favorite horse has the lowest payout. The long shot has the highest payout. So what happens is somebody could actually get a piece of this right, and then you could watch prices actually move in exactly the opposite direction. How many times have you ever seen that? So if these folks that play this game weren't emotionally confused enough as it was, you add that into the equation, and you got a lot of people making a lot of emotional, irrational decisions day to day that are moving this thing up and down. I would say the fact that, you know, this pari-mutuel kind of element, that when the news is bad, a lot of times prices go up. I can almost assure you that in the environment that we're in today, prices will start to go up long before the news gets better. And that's what makes, for most people, this fairly maddening and quite challenging. Any questions on that? So that's all the stuff we don't know. Let's try to look at what we do know or can know. And so we think all you're doing in the stock market is that you're buying a business. You're buying a piece of a business. Nothing more complicated than that. And we think if you're buying a business, you should use the same two variables to make that selection as you would use to purchase anything. And that's the quality of the merchandise and how much am I paying for it. So, you know, Lane is doing our video today. How you doing, Lane? And Lane's been doing this quite a while, and he's really good at it, and he's got a lot of equipment, right? And so if Lane's going to buy a new piece of equipment, he's going to do a lot of research. He's going to figure out what the right brands are. He's going to know if it's a used piece of equipment, what the condition is. He knows what he needs for his uses. And the more time and effort Lane puts into trying to identify this equipment, the better job that he's going to do being able to select it. And we think as time goes on, if he does enough research, when the right piece of equipment appears, he's going to know it. He'll see it crystal clear, not ambiguous, not emotional. And then the next step would be, well, how much is it? And is the price reflective of the value that he's going to get? And we think you could do the same thing with purchasing a business. That you could create a criteria to try to identify why one business would have a distinct advantage over their peers over time. And we think the more time and effort you put into it, the better you're going to get at it. And we think eventually, if you put enough work and effort and you use a good process or good criteria, that eventually you'll be able to create a criteria to where when you see a business that fits that criteria, you're going to know it. It's not going to be emotional. Doesn't matter what's going on elsewhere. You'll see it crystal clear. It's just like playing baseball and that big perfect pitch comes right down the middle. So we think once you identify the target, and you can see that crystal clear, then the next step would be, well, what represents a fair price for somebody to want to own that business and let it compound our money for a long period of time. And that's based on what any investment should be, because without this, we don't believe it is an investment. And that is, what's that company's cash flow today? How much are they earning? And then what's the trajectory of that cash flow look like between now and as far out as you can see? And based upon that cash flow, you could determine what would represent a fair price to pay today. And we think we can come up with and we spent a fair amount of time, particularly recently on this, we can come up with a pretty tight number as to what would represent a fair price to pay for a business that you wanted to own for a long period of time. You would let the company compound your money for you. So we think if you know exactly the company that you want to own and within a tight range, what would represent a fair price, and you could see those two things crystal clear, no emotion, then we think the more asinine everybody else's behavior in the short term, based upon a set of variables that has no predictive value whatsoever anyways, the better it is for us. And under those circumstances, this just becomes a ton of fun. You just go out, you find these great companies, and then you wait around and you wait till the price gets to where you want it. If you don't like the price today, they're going to offer you up another one tomorrow. And believe me, in this crazy environment, you'll always, if you can wait long enough, you will always get your price. There's only, and we think our results have proven out that if you do that and you do it consistently and you create a good process and you work the process properly, that your money will compound at very attractive rates over a long period of time. So it's a ton of fun, and you can make a lot of money at it. That's pretty good stuff. There's only one drawback. We have no control over the fluctuations. We have no idea what's going to happen tomorrow or next week or next month according to the fluctuations. That's the only thing you have to give up. If you do your homework properly, the company will eventually grow through whatever chaos the markets will provide in the short term. But you have to live with unpredictable fluctuations. Any questions on that? The other advantage of understanding business, being a business analyst and not a stock market analyst, is that the knowledge is cumulative. So if you learn about one business, it's going to help you with another business. And as time goes on, you actually get better and better and better. And that's pretty cool. There aren't a lot of things in life where you actually get better over time. The problem with the geopolitical macro environment and those that spend their livelihoods trying to predict all that stuff is that the knowledge is not cumulative. And so if we would have decided that we needed to know everything there is to know and be experts at a pandemic, it would take us several years to understand even remotely, like Dr. Fauci maybe, right? And then here comes a war in the Ukraine. And now we have to be military experts on Eastern European military tactics. I mean, they're always running on a treadmill. And so the cumulative effect of the knowledge we think is quite powerful. So the purpose of everything that we send out, either in the letters or in the emails and these meetings, since we don't think you can judge us properly based upon short-term performance or short-term volatility, that the only way that you can judge us is that we have a good process for selecting these companies and we're executing effectively against that process. And so that's the information that you need to be able to determine whether we can continue to compound money at the same rates that we have over the last 35 years. So we have to enable you to get that information. And so that's why one of the primary reasons why we're here tonight is to have you ask us questions about both our process and how we execute against it. And particularly, I think that our process has gotten better and better, and particularly the work that Jeremy and Dominic are doing. They're hitting the road, they're visiting all of our companies, and they're also involved what we call our Gemba activities. And we think through that work, our knowledge, our process is getting better now at a dramatically accelerating rate. And with that, we will open this up for questions on any subject matter you want. And the subject matter, obviously, that we are best suited to answer questions on are anything about our companies, anything about our criteria, and anything about how we try to follow these companies to make sure they're living up to the principles that we think are going to give them an advantage going forward.
I have a question.
Yeah, and maybe we could go, Ginger, to the criteria.
So do we need to pass around the microphone so that the questions
Yes.
can be heard on the video?
Try to throw me off by putting this up here and I'll have to move it. Russ, these companies are being bought and sold by other people. You guys.
Yes.
And according to what you said earlier, the vast majority of those people are making decisions based on a bunch of criteria that, in your estimation, is not smart.
Nonsense.
So, if those stocks are being buffeted by the same pressures that all other stocks are in that turmoil of the vast majority of people making bad decisions, what is the premium to what you bring? I mean, there's got to be some other people buying and selling based on similar types of criteria. So what is the premium? How do you think about the premium that your approach brings to owning these companies when they're subject to the same bad decisions that everybody else is making? Do you understand that
Totally.
question?
I think I do anyways. And you guys could chime in here, but so in the long run, the stock will track against that cash flow stream. So we talk a lot about just the S&P 500 index, the largest 500 companies in the United States. Their return on equity, which is a measure of cash flow, how effective their cash flow is based upon the capital that they've built up so far. That number, that return on equity number for the largest 500 companies in the United States is somewhere between 9 to 11%. The return on S&P 500 over a long period of time is somewhere between 9 to 11%. You could take it to the bank. In the short term, it can vary dramatically, which we believe is an advantage to us. But in the long term, if you don't believe that that eventually comes together, then this becomes a very confusing environment. You have to believe that in your bones. And we do. And it has proven itself over a long period of time. You know, we actually looked the other day, and the lowest cost basis that we've got for Cognex in the fund is $5 a share. The stock's been as high as 100. It was 70 not too long ago. It hit 47 today. But our cost basis is $5 back when the fund got started 11 years ago. But did it really matter if we would have paid 7 or 5 at the time? Over a long period of time, if these companies compound these earnings, it'll compound, the stock will compound with it over a long period of time. That's our belief. You want to follow up on that?
Russ, follow-up question to that. So, you can buy the S&P as a group, and you can just play the...
Well, hold on for a second.
You can buy an S&P index fund, play the long term. I think the question he's asking is, why not just do that versus invest your money at Front Street?
We offer the index, and anymore for new investors, we'll probably put 80% of their money in the index and 20% in Tarkio, just for the fact that Tarkio fluctuates differently. Other advisors have a way of attacking our fund because it's a small fund run in Missoula, Montana. And yeah, the index is phenomenal. And the answer to your question is that that's our entire equity model, is some balance between the index and Tarkio. And if we
Over the long term.
yeah. And if a new customer comes in and they're more comfortable in the index than Tarkio, that's where we'll put them. And we don't charge for the index. We only charge what goes into Tarkio.
Separate question, but is there any part of the strategy that plays purely off of the irrational side of the market?
Jeremy, you want to take that?
I think you're on a roll, man. I would say that the strategy doesn't work correctly if the market doesn't act irrationally in the short term. Certainly, we might value a company, let's say we value Cognex differently than you might value Cognex. If you've been researching Cognex over time and you think it's worth a certain amount that you're willing to pay for the stock today because you feel like its cash flow stream over a long period of time is going to be, a certain trajectory. We might think that the cash flow stream is going to be a different trajectory, and we might value it differently. We might both be acting rationally. But most stock trades are not long-term rational stock trades. They're, in our opinion, and I think it's the truth, they're based on sentiment. They're based on what's happening in Ukraine. What do I think is going to happen to the stock over the next 5 weeks or the next 2 days or the next 3 minutes? What's the interest rate going to be at the next round of interest rate raises? What is China going to do with COVID over the next couple months? How's that going to affect the supply chain for a variety of things? So it's not that everyone is acting irrationally. It's that they are acting rationally based on influences that they can't predict and short term. So that, and because you can't predict it, and because you're trying to predict short-term effects, we think that that activity in and of itself is irrational. And so without that, the stocks don't trade at prices that we want to pay for them necessarily. We don't get many chances to buy Cognex over time, but right now, I mean, it's trading at
20 times earnings.
Which for a company like that is, you know, for us, it's really cheap. And so we, you know, if everyone out there was acting rationally over the long term, assessing Cognex's ability to gain market share in the market that they are in, which everyone agrees is a market that's expanding at the speed of light, we wouldn't be able to buy the stock for that price. So the fact that this irrationality is happening around us allows us to execute our process and be successful if we stay rational and we focus on the things that we understand, can predict, or we think are controllable. I don't know if that answers your question, but we are not trying to do something irrational, but we need that irrationality in order to execute our.
Well, it's there. I mean, whether we like it or don't like it or what, it's there, and this is how we're addressing the fact that all this stuff happens in the short term. I will say another thing too on some of these geopolitical macroeconomic events. There is no question that from time to time some of this stuff is going to interrupt this cash flow stream for our favored companies. So that's why we have to make sure that we buy the stock cheap enough to where even if the earnings get interrupted for a short period of time, that the stock will come back to the level that we paid for it and then keep going beyond that. We're not saying that these events will not interrupt earnings once in a while. And we don't even know, you know, what events are going to interrupt our earnings and which ones don't, to tell you the truth. But sometimes they will. And we're fully aware of that. And we have no problem with that whatsoever. We have to make sure, though, that the company is strong enough to get through that, whatever disruption is occurring to them, and then that cash flow stream starts back up on the trajectory that we thought it was going forward later. The other thing that we're doing in here particularly is that this, I mean, we keep talking about Cognex. It's really our best company. I mean, it's a little like choosing your kids, I guess, but we've owned it for 30 years. We know this company. Their culture, according to this criteria, is as phenomenal as anything that we've seen. The way they break down barriers and empower people is through theatrics. I don't know if any of you have seen their annual reports every year, but that's the culture of this company. And they create an environment for their engineers to create. What they do is they do machine vision software for robotics. And we've owned this 30 years, and we still think that this industry is really at the very earliest stages of what we could imagine. In fact, it's just starting to get real traction, in spite of the fact that this has been a dramatically successful investment for us over the last 30 years. And they have no debt. They usually keep somewhere as close to $1 billion in cash. So whatever disruptions occur, it ain't going to affect them because they could just blow right through it. There's so many things we love about this company, but the other thing that we love about this company is they're very long-term oriented, which means that they're willing to sacrifice short-term earnings for the long-term health of the company. So in this particular quarter, companies are having a difficult time getting semiconductors and electronic parts. And so what Cognex decided to do was that they purchased the parts this quarter from, the industry calls them brokers, I'll call them scalpers, for ridiculous sums of money. But they have 20% after-tax profit margins. So they can afford to pay a lot of money, more than their competitors, for these components to deliver product to make sure their customers are happy. And it hurt their earnings a little bit this quarter. And in this environment, it just caused this ridiculous spiral, which for us is pretty awesome. Because this company is so rock solid, it's unbelievable, and they're in this industry that we can see out for as far as the eye can see. Jeremy, you want to add something to that?
Where does Cognex normally trade? Price to earnings ratio?
50, 60?
And it trades that because
Times earnings.
because the
Times
market,
their cash flow.
and it trades at that level because the market predicts that their growth is going to be so great that it's worth that hefty price to pay for it. Because it dominates a market that is going to be in every industry over the next several decades, and they dominate it. And the reason they dominate it is because they spend so much money on R&D, because they hire awesome people, because they love to work there because of the culture, because they empower them to go out and create totally cool things, because the culture allows them to collaborate together better than anyone else, and they pump out the best products, and they understand what their purpose is, and they connect it with their customers. So their customers, they continually gain market share. They can charge, what's their operating margin?
20% after-tax margins.
20% after tax, but their operating margin is like insane. So they can charge a lot of money for their products, and their customers will pay it because they bring a ton of value. And they know they bring a ton of value because they keep their customer in mind as they're doing everything.
There's only two competitors really of significance in this industry. And they also have had probably the best CEO transition that we've ever seen. And Rob Willett took over 4 years ago. So he's a young guy. He's a fabulous CEO. In fact, the transition, he's a terrific guy. The founder was kind of a challenging personality, and Rob managed through that. And now we think this company is in fabulous hands for the next 15, 20 years. Jim.
Russ, I guess kind of a follow-up question to the S&P 500 index that we were talking about earlier. Get away here. So actually my question is on the quarterly reports that we all get. Is it still your intention to, by sending those out and indicating what front-page capital's progress has been versus the S&P 500, that the intent is to compare yourself to the index, and at least years ago, your philosophy was always that you could beat it, and you intend to beat it. Is that still why we're getting that as a comparative thing?
We send out those, I mean, we've always sent out those reports. I think it's fair to, I mean, we could just send out a report that doesn't compare it to the index. That's the industry standard. The long-term equity accounts, most of those accounts still are significantly above the index. Actually, Tarkio is a bit below it on the inception, the 5-year, and the 10-year. You know, we're not going to do anything different because of that.
Yeah.
You know, the one thing that we are going to do is to try to keep getting better and better and better. And if we happen to beat the index, terrific. If we don't, we're fine with that too. All of our money is invested in the equivalent of the equity accounts or Tarkio. You know, the index has outperformed itself for the last 10 years. Dominic just ran through those numbers. I think, I don't know if you remember the chart that we've talked about over a long period of time, where from 74 to 2000, that run, the index actually did 13.5% for 25 years. Over the last 11 years, the index has done 15% compounded. Our numbers are running right around 12. Our numbers, if you look over the last 35 years, just about 12. Our numbers haven't changed that much. The index has done better. You know, there might be I've thought of a variety of issues that kind of interrelate with that, but to us it really doesn't matter because we're going to keep doing what we're doing.
So you're saying your benchmark really is just for you to be steady. Is that true and not comparatively?
Yeah, our benchmark is for us to get better and better at our criteria and how we execute against it. And we think that if we do that, we'll compound at high rates. And yeah, we do. I personally think, since we spent at least 25 years beating the index before we launched the fund, that's what will reoccur again in the future. But you know, if we're close to the index, and if somebody is uncomfortable with that, we offer the index. I can set you up where I can guarantee you that you will not underperform the index. Which is why we added the index to our repertoire.
Well, given what you said about, and have always said about your long-term perspective on things, there was a day when I was sitting here without all this gray hair, 30, 40 years ago. And investing for the long term makes a lot of sense. But perhaps can you appreciate that as you get to be my age and maybe older, that when you hear someone say that you got to stay in there for the long term, well, what if you don't have a long term? Just saying. In other words, how do you counsel your clients who are of different ages? Because I think there really should be, would you agree, different investing strategies depending on where you're at in your life?
Actually, no. There is no such thing as short-term investing. That's just speculation. If you're not investing for the long term, you're not investing. And we could go through an exercise for you if you care. It's really kind of fun. But the way compounding works is that the biggest payoff comes at the end. And you know, most of Warren Buffett's net worth has come after he's been 65.
How old's Warren Buffett?
91.
Half of his net worth has come since he was 83.
Yeah. And so what we do, the way we approach this, is that if you look at but either the index or at the performance numbers that you referred to. Both strategies have compounded at a rate that's a multiple of 5%. So the way we've addressed it is that when you get to the point where you need to start drawing out, that you can't put money back in anymore, that our belief is that you could take out 5% a year and still build value, never touch your principal. And the only thing you have to do is live with the fluctuations. And there is a tendency, we have found, that folks that take a monthly check have a tendency not to worry about the fluctuations as much. And these accounts, we've been doing this now for 20 some odd years, sending out monthly checks. We've never missed a monthly check. And even in 08, 09, we never missed a monthly check. Even when things are down, you're only selling a little bit. You're selling 1/12 of 5% during that particular month. So it doesn't disrupt the process hardly at all. And so that's our solution, particularly during the last 10 years when interest rates were at a level that was lower than it has been for quite some time. And I can define that for you if you'd like. That would be the last 4,000 years. Interest rates got to be the lowest level that they've been in the history of capitalism.
But would you say then in summary that it's kind of pointless for us to get our quarterly statement, grab a little calculator, start calculating, percentage differences between your performance and the S&P and certainly in the short term, quarterly, probably not even yearly. Is it the inception number that really matters?
So if you're trying to evaluate us, we think that looking at those numbers is under almost any circumstances other than maybe since inception or long 10 years or 8 years or something. But the real way that you need to evaluate whether we're capable is this criteria solid? Is it rational? And are we executing against it? And what are we doing to execute against it? And that's why we're here tonight, is to answer those questions about our process and what we're doing to make this better and to find companies that fit the criteria and how they fit it. I think we've described that a little bit with Cognex, but that's really what you need to evaluate us on. And if you're comfortable with that, we should be able to continue to at least perform as well in the future as we have in the past. And my contention would be with the work that Dominic and Jeremy are doing in particular, it should be better. Brian's got a...
I'm going to challenge you a little bit on that. This is, and the reason we invest with you is because we trust you and we expect you to know more about it than we do, because you spend all your time doing it. And this all makes perfect sense, but with respect, we really don't care what, I think most of us here probably don't really care what you use as long as it provides a good return in the long term. I could be wrong, but I think most people, you could put something else up there that might make just as good a sense to us, and we wouldn't care if you don't, as long as you produce a great return over the long term, what you've done. That's how we judge it, I think, especially when you get to the point where you're trying to live off of it.
Yeah.
I mean, it makes sense, and you've sold me. I've interrogated you many times, and probably will do some more. And you've sold me on it. But the point is that it works. That's really what I think the way I evaluate you is, does it work? And not in the short term, but in the long term.
Yeah, the problem is that we do go through periods
But that's
where it
the
looks
short
like
term.
it doesn't work.
Sure.
And the only way that we can give you confidence is to talk about the process, because
Yes.
talking about the numbers at that point in time is sort
If
of
you've got a
a,
long enough track record, you can talk about the long-term numbers. And you do. But my point is that when it really comes down to it, most of us here trust you to do what you do, all of you, so well, because your long-term track record has proven itself that it works.
yeah, our belief is that trust is something you have to earn every day.
Of course.
And that's what we're here to do tonight, is to try to keep building on whatever
Who
we've
was it that
created.
said in the short term, the stock market's a voting machine, and the long term, it's a weighing machine?
That's Ben Graham.
You subscribe to that, I'm sure. That makes such
Absolutely.
great sense to me.
David, is that correct?
And he touched on it a little bit about people looking around this room. I suspect I'm not the only one that's at or approaching this stage, is when you're planning to live off the money that you've invested. And you talked about it a little bit, 5%, that 5% rule. Obviously, when you have a year like this, how long have those periods been when it's been a 20% or 30% drop? We've talked about that a little bit, but I can't recall.
Yeah, so the worst situation that we've run into so far is obviously 2008, 2009, and we fully recovered in 12 months, but that's the worst situation I've seen so far. I mean, the pandemic seemed like it was worse because the outcomes were quite unclear, but as you know, the recovery came much sooner than that. And the other thing I'll say is a lot of it, I appreciate, I mean, I'm similar age that you are, Jim, so well, I have a low stress job. I say that all the time when people make that comment, but really it's true. I mean, living with these companies and investigating the companies and being able to buy them at cool prices really is no stress. It's just a lot of fun. The only stress that we get is your guys' stress. And that's difficult, and we emphasize with you, but I don't know, there's only, that's the only stressful part for us. And in talking about age, it is different as you get older, but what we've perceived as the bigger problem is that as we get those that we've worked with for a long period of time, as they've gotten older and gotten to this important age, the other thing that occurs is the accounts get huge, and that becomes more uncomfortable. The fluctuations, the story I like to tell is I worked with he was a former CEO of one of our companies, and he had us managing some money, and we went through a very similar situation. I think things were down 20%. This is back in the 80s. And he called me up, and man, he just reamed me out. And he goes, and the account size was, I don't know, 100,000 or 80,000 or something. And he goes, I could have bought a shopsmith with that money. This is back when they had shopsmiths. And so if he would have hung on, which he didn't, by the way, then eventually it would have been a car, and then a house. And then it does get more difficult as the numbers get bigger. But that's what we think we're put on this planet to do, is to get those numbers to get to where you're more uncomfortable with the fluctuations because they get bigger and bigger.
Okay, so this may be an old simplification.
Uh-oh, we need to.
But are you saying that I should spend more money?
Don't ask.
Yeah, actually, Dan, could you answer that question, please?
No. What was the question? Should she spend more money?
The accounts get so cumbersome. I don't want you to be stressed.
He wants to spend more money so you're not stressed.
I will say that particularly accounts that are taking monthly incomes, That's sort of our primary focus. Now, the accounts do get larger than what they need for a monthly income. Folks have a choice of once in a while maybe bumping that up a little bit or taking a little bit more out. But sometimes there's a tendency to take a bigger piece out because it feels like it's, you know, the size of the account enables you to take a larger piece out. And that's cool, we're fine with that, but we do understand when these kind of events occur, if you've done that, it's more uncomfortable than if you didn't take the chunks out. And we don't care one way or the other, but we do know that it causes more anxiety when you take the larger pieces out and not smaller pieces or just the monthly income, or bumping up the monthly income little by little. Yeah, Pete?
So I've known you since you went to Missoula, right? Not when you went to school here, but now.
1979, Pete.
Yeah.
So I worked with Pete's dad at Piper Jaffray, Dean Mart. Go ahead, Pete. But when I got there, we were the only two people in the office.
That's been good. So you got kind of giddy when you said Cognet's spiral. Just 15 minutes ago. And why did you do that?
When it spiraled downward.
Yeah, why did you get giddy? And that was good for you.
Yeah, I mean, what we've been doing the last 2 weeks, we've got some other situations that are super exciting and really very well priced, but for the last 2 weeks, we've really only been purchasing one company,
Which is?
Cognex, because it's a rare event to see this treasure selling at this valuation.
Back to the original first question, and then the follow-up. Do these spirals affect you? Yes, they do, right? You buy more.
Yeah, actually in a positive way.
Yeah, it doesn't affect your standards and what you do. But does it affect you? Yes, you buy more. That was the answer that I thought that I would get.
With the caveat that we need to be totally clear about where that company fits on our criteria.
All your
Yeah.
criteria.
So as long as we know, like Russ would say, cold, if we know that it fits, then we can act quickly, we can make a decision. I mean, Cognex has been down for a while, but usually when it goes down, it jumps right back up.
Yeah, and you wouldn't have bought more Rogers.
We had not bought Rogers for probably 6 years. Yeah.
So yeah, the answer is yeah, it does. So I have another, this is more of a loaded question. I was kind of
Oh, good.
trying to
Oh, you're setting me up.
help you.
No, you're setting me up. I get it. That's good.
So if the fastball's coming down, it's crystal clear, and you have a value for every company. So what is Tarkio Fund worth? Somewhere
That's a
between
good
15 and
question.
30, but by the same token, you said that you're buying Cognet 4 times price to earnings or whatever, and now it's 27, and it's still a good deal. So what is it worth? And I don't say that to scare everybody because you think, well, that could be worth $12 or something. What's it worth?
So,
Unless you
do you remember Longleaf, the Longleaf Fund? They do that. They say, well, our companies are, they're selling at half of their appraised value. And they, given the way they operate, they would probably answer that question. We've just started to do that work. So our appraised value on Cognex was... No,
sorry.
79,
Yeah,
89, one of the two of those. I've resisted that a little bit. I've been sort of pushed along for that exercise, and we're doing that really now with all of our companies. I don't know. I've never done it, so I don't know if there's a danger in getting too far down the path of oh my God, it's worth 80, so it's 40, so, but we're doing that work, and we've gotten 6 companies maybe done so far.
I think something like that, 5 or 6.
Yeah, and I would say all, with one notable exception, at least 4 of those companies are selling at least a third of what we appraised the value as.
Make it easier, I would suspect you believe Tarkio is worth more than 15, or whatever it was today.
Yeah, no, it's 25. You're jumping ahead of me, Pete.
Yeah, 25.
Now, tomorrow's another day, so.
I got the 5 part right.
We've never done that exercise before, but we're doing it with individual companies. And I'm sort of being pushed into that, kind of kicking and screaming a little bit, but it's been a great exercise, and it's opened my eyes, and the conversations have been terrific, and it's good stuff, and the values here are just eye-popping.
So can I?
For those of us who don't know, you say 25 today, is that the cumulative P&E of all the companies that own?
No, that's the value of Tarkio, $25 a share.
So if you take all the shares of all the companies that Tarkio Fund owns, and you divide it by all the shares that are of Tarkio Fund that are owned by all the people that own it, that's how much per share. And that's calculated at the end of every trading day. Can I take a crack at?
That's what you get if you sold.
Yep. So I, along with all of us, buy Tarkio Fund every month, a dollar cost average. So I buy it regardless of whether it's trading up or down. All of us. And when it's trading low, like I believe it is right now, I get more Tarkio Fund shares for every dollar I put in, which is great. So I love that. So when things go down, for me, it makes me happy. When it's trading at the highest that it's ever traded, I was 32. I was more than happy to continue to dollar cost average and buy it at 32. So. Yeah, right. But I'm more than happy to trade 32 of my dollars for every share of Tarkio. Yeah.
And by the way, Jim, kind of follow up on yours, that myself personally, I don't have a nickel in the index. And we have a fairly sizable portfolio, including the Front Street pension plan, and we don't have any index in there either. Gary, we're going to get you a mic, Gary.
I appreciate all the effort in the criteria to buy funds. And you have a similar criteria for when it's time to sell something. Okay, so for instance, Rogers, you say you haven't bought for 5 years. And we happen to be fortunate that with this buyout from DuPont, I guess, that makes it a perfect time to buy, but you can't count on that sort of a thing happening. So at what point, I mean, typically I would guess, although I don't know, that the companies that you invest in, if things are going south, they don't go south in a hurry. They kind of waffle their way down until all of a sudden you wake up one day and you say, holy crap, I should have gotten out of this a lot sooner. So can you say something about the criteria to decide to get out?
Yeah, that's a fabulous question. I appreciate the question. So the way we address that is, so not to keep beating a dead horse, but this is the criteria we use, right? We have companies through research, primarily through the work that Dominic and Jeremy are doing, and if we can answer questions on what they're doing, which is pretty cool stuff. But we think we can have a pretty good idea whether that company is getting better and at what pace maybe they're improving. And then we have other companies that maybe had a management change, they're not as committed to the old principles, you know, that we're starting to get a little uncomfortable, little less comfortable with them. By the way, that can ebb and flow. We get a little uncomfortable and then suddenly, you know, something happens or they behave in a certain way that gives us more confidence. So it does ebb back and flow a little bit. But we do definitely have companies that we can see crystal clear that are making dramatic strides in getting better. And occasionally those, and what we, the criteria that we use, nobody else uses. I mean, there are fundamental stock investors that use solid criteria, but they don't use this criteria. This criteria is, we know of one other person on the planet that basically uses that criteria, and he's brilliant, and he's a good friend of ours, and his work has really enabled us to take, we think, what we're doing to another level. But we've got companies that are getting better, that occasionally the stock is getting worse because their industries, they had a bad quarter, they, like Cognex, decided to, you know, buy all this stuff through scalpers and it hurt the quarter. Maybe their industry's going through a downturn. Any one of a variety of reasons. A company that's getting better and better and better, the stock's getting cheaper and cheaper. And we want to buy more, right? But unfortunately, you know, we're not Jay Powell. I can't print money. We do not have the ability to print money. So I got to get that money from someplace to take from that and to put it into that. And so we've got other companies like Rogers that had not, or we believe were not getting better, but the stock was going up because, this is before the buyout, because they sold some products, some materials that went into electric vehicles. So we're going to take the money out of the one that's going up, that according to our criteria is deteriorating, and put that money in the one that's going down and getting better and better. And then we do that regularly, little by little, and eventually we wake up one morning and XYZ that we've been nibbling on is gone. And that's how we eliminate a position. Because it is gray. It's not, these things don't change overnight. So it's worrying us a little bit. So we'll take a little off and a little off and a little off. And then suddenly, a lot of times, it'll just disappear.
What you haven't, if I understand what you said correctly, you're selling off something that's poorly performing to put that money into something that is a better long-term strategy at a good price.
So actually, we're selling something that's stock-wise is performing well. The stock's going up, but the fundamentals, according to our criteria, are deteriorating.
Right, so the company is underperforming as a company, not as a stock.
Correct.
Okay, so my question is, and you're doing that so that you can then take that money and put it into a company that is performing well as a company and may not be performing well as a stock. Okay, what I want to know is, what if the companies you're looking at, all of them are performing well as companies and performing well as stocks, so they're not good buys, and you have another, and you still have a company that is not performing well as a company. Do you have a criteria to sell that and just hold the cash, for example?
Yeah, so the answer, Michelle could answer that for you. Never happened. I've never not had 2 or 3 companies that I've been chomping at the bit to add to. Never. And
I'm not concerned.
that could be a personality flaw.
To add to. I'm concerned about not being willing to sell an underperforming company that's underperforming as a company.
Yeah, again, we traditionally will use the buy side to make the sell decision.
So what you're saying is you will hold a company
because it's not going to get terrible
underperforming
overnight.
As a company.
Say that again.
What you're saying is the only reason you would sell a company that is underperforming as a company is so you could buy a company that is performing well as a company and not so well as a stock.
Yeah, the only caveat that I would add to that is that, I think you used the phrase poorly performing. These are all great companies. Even the companies that we're selling, they're pretty dang good companies. I mean, just to get into the stable, we think is a high bar. So it's not like overnight this thing is, turned into a piece of garbage. It's little by little, we're just going, we're a little concerned about that. And so that's how the process works. If something happened overnight that we could see, we would certainly take action. But it's never happened in 40 years. Things don't change that quickly. And it's the vetting process just to get in the portfolio, we think is quite stringent. Jeremy, you want to add to that?
I mean, I don't know if I can add anything more other than I'm not sure I can add anything more.
Wow.
Yeah.
Did you get that on tape, Lane?
Russ, it's a no turd guarantee.
Brian, we need a mic. Oh, Matt.
And I get maybe one thing I would add. Sorry. One thing I would add is that it's a good point that what's the criteria for which we would sell just to keep it as cash if everything else was up. I think that before it gets to that point, we're already selling because something is down. We need the money. We want the money. We're looking for money somewhere. And we know that this company is starting to slip, or we're not quite as confident in our ability to project it out and to see all the characteristics of that we can predict its success over time. And that as that starts to slip, it becomes one of the things that we decide we can pull money from. Another one might be a really great company that we don't want to sell, but it's really high priced. And so we're choosing between this one that's really high priced and this one that's not as high priced, but this one we've had no questions about, and this one we're starting to have questions about. It becomes the time to sell, and that's why we only take a little bit out at a time and ease out.
For me, the selling these companies that we know this well, even though they're slipping a little bit, but we need that money to buy something else, it's still kind of painful to sell those. I mean, we got one right now that is one of the best companies on the planet that is really overpriced. And I have a hard time selling it because the capital gains is so dramatic on it. And we've already got capital gains from the Rogers. And B, every time I've sold it, my phone rings off the hook telling me how stupid I am.
I was just going to ask quickly, do you ever base that feeling on the industry they're in, that it's maybe becoming obsolete, becoming less?
The question is, do we ever base that feeling that we want to sell on the industry
Yes.
trajectory?
Yes. We have a couple of very cyclical companies, Nucor being the primary example. And in 2007, we've owned this since 1988, I believe, uninterrupted. Criteria-wise,
89.
phenomenal. I mean, couldn't be better. Decentralized, empowered, flat organizational chart, the lowest cost steel producer on the planet. We got completely out in 2007 because of the site, because it's a very cyclical business. Had never done that before. And we got back in 2009. And we've owned it ever since, and I'm getting a little nervous with it now, by the way, because the steel cycle is, it is always cyclical. But one of the biggest problems I've got is that we've already got all these capital gains on the Rogers, so I'm sort of handcuffed on doing much else. Matt, sorry.
No problem. The first thing I want to say real quick is to everybody here, and that is, recently I went through a little tiny bout of the irrationality over Cosmex, which I feel really good about. But I want to encourage everybody here to be willing to reach out to anyone at Front Street, especially Tom and Jeremy, because when you have questions or you're kind of tied up in your head, in my case, I was all wrapped up over, should I buy Cognex, right? And the way you guys treated it and the way you guys treated me in answering my questions was phenomenal. And I thank you very much for that.
Thank you, Matt.
Also, yeah, for sure. And then, just a super quick story. Very recently, I was in an airport, looking out the window at a GE engine in an airplane that was going to safely take me home. And while I was waiting for the flight, I was on a communication device that was fundamentally using Lumen. And I was buying stuff on the internet that was fundamentally being processed by Cognex. And then I used a different communication device to call Rebecca, and I was talking with her about our children, and she was talking about how they had just gone to Chipotle, and that's their favorite restaurant. And that when we got back, we were going to go to Container Store. And you guys, at the very start of the pandemic, Russ bought a bunch of Container Store for me. And he bought it at, to the penny, the lowest the stock went. And I actually, Russ doesn't know this, but I actually said goodbye to my money. I said, bye money. Because I just thought he was insane. These stores were all closed, and I trusted him, so I sent it. And it was like a 10-bagger for me. It was just really beautiful. But fundamentally, I'm sitting in this airport like a month ago, and everything I was doing was fundamentally what you guys have your hands on. And in my personal opinion, I think you guys are absolutely crushing it. And I think this is going to work really well in the future. I think you're very current and you really know what you're doing. So it's just a thank you.
Thank you, Matt.
Russ, can you tell us how margins work?
So the question,
well, we should have the question on the, and then give it back to John.
Russ, could you tell us how margins work?
Yeah, basically what a margin is a loan. So it's a nice tool for liquidity, that if you need money quickly, that we don't have to decide to sell something immediately. You could take the loan out and then we could take our time and sell it. And by the way, I've been using that tool quite extensively over the last couple of months with the idea that when a snapback comes, that will clean everything up. Sort of drug out longer than I thought. I've been through this before. We use the same tools in 08, 09, and there's a lot of people that were super uncomfortable. But maybe once every 7 or 8 years, it drags on a little longer than you thought. But for the rest of the time, it's been a wonderful tool. And once in a while, you get caught and you have to wait a little longer. But the purpose of the tool is to enable you not to have to sell on their time, but you could sell on your time. And if things get worse, that means you just have to wait a little longer. It doesn't mean that the tool didn't work for what it was designed to do. Does that make sense?
Yeah. So you just, there's no time limit, I guess.
There is no time limit.
But the stock is still there and the loan is from you guys.
TD Ameritrade, the loan is from, yeah.
Russ, I very much like your Tarkio's criteria. We all do, obviously, but they're principles, and they're hard to score. But it must be hard to compare different companies by these qualitative principles. So I would love to hear a little more detail on that, and particularly the first one, because it seems to me that what has changed, we made some references to things not changing in the last 40 years, but the SEC gets weaker and weaker. They get more enforcement averse. There's higher and higher executive compensation and pay by options and whatnot, and other things that dilute shareholder value. There's ratings agencies are gotten pretty close to fraudulent. And so how do you look at that in a rigorous way? That's the one that keeps me up at night.
Yeah, so I'm gonna take a piece of this and then I'm gonna pass it on to Jeremy and Dominic and chime in too. But on the first criteria, we just added humility as to a very, very important characteristic that we look for in these leaders of these companies. And the best way we can answer the first criteria is that we think that that's the big advantage of being a long-term investor. Because the way you really find out who somebody is during stressful times. And we've owned these companies long enough to where we have seen how they have behaved during stressful times. And particularly after the pandemic and after 08, 09, probably for the next couple of years, sort of an answer to Gary's question, how these folks behaved during that stressful environment was a huge influence on which companies that we shaved back and which companies that money flowed to. And so that's the big advantage of being a ridiculously long-term investor, that you actually get to understand who you're dealing with. And that said, I want Jeremy and Dominic to maybe talk a little bit about, so early in my career, I traveled and visited all these companies, and I got to know these people, and then I decided I didn't want to travel as much, and there's all this information on the internet, and I thought that I could sort of gather this information electronically rather than in person. So there was a, 6-year period maybe where there wasn't a lot of personal interaction going on. And we were doing great. Those were good years for us, so I figured, hey, maybe it's not as important. Kind of back to your answer to your question, maybe it's catching up with us a little bit, that the traveling, maybe it's weakened our performance versus the index a little bit. I don't know. There's a whole variety of reasons what, you know, that I could probably, or excuses I could come up with. But Jeremy and Dominic are on the road at least twice a month. And they're doing this now in a way that is so far beyond any of the work I had ever done. And the reason is because the criteria is tighter. We've got this criteria. A subset of companies that behave this way is something called lean. And lean is a management philosophy, basically. And it has a long history. It goes all the way back to Toyota after World War II. And Jeremy and Dominic have become very knowledgeable, stepping into being experts, but we're trying to be humble where we're at. We do have this relationship that I talked to you before about a true legend and expert in this field that has been kind enough to have a friendship with us. And in addition to that, we decided that being an observer of this behavior and these incentives and this type of management structure is cool. And I did that for a long time, and we think we got a lot of traction out of it. But we decided that if you really want to know this stuff, you better go do it. In answer to your question, Deb, the Japanese call it the gemba. It's the place where the work gets done. It's where you get your hands dirty. And that's our association with the Ranch Club. Jeremy, do you want to take it from there?
Yeah, there's a lot in that.
There's a lot packed into that sentence.
So we can talk a lot of that, and happy for the group to direct the conversation if there's anything of particular interest. But we'll start with kind of Dom and I are traveling to all these companies that, you know, are in the fund, that are in your accounts. And, you know, we meet with the management teams of these companies. We talk to, you know, the CEO of a $1 billion company or a $2 billion company, the CEO and CFO of a $1 billion company. And we brought Andrew, who's in the back of the room, to chat with these folks. And it was the Container Store. We went to Dallas, Texas. We sat
Andrew's the golf pro at the Ranch Club.
We sat in the room with them, and the reason that we thought it would be good for Andrew is because he runs a little retail shop down there, down at the clubhouse, and he sells, you know, shirts and golf shoes and clubs and what have you. And these guys are one of the coolest retail outfits in the United States right now. And so we get to go sit down and meet with these folks, the CEO and the CFO of this $1 billion company, for 4 hours. And we sit and we talk to them, and they know we're investors. So they have their little investor presentation that has, you know, kind of what all their numbers are and what their sales trajectories are and what their new products are and what their strategic plan is. And they, you know, they hand it to us, and they're all laminated, all nice, and they're all dressed in suits. And we show up looking like that, not like this. And Andrew showed up looking like that.
Oh God, Andrew.
And it took them about 1 minute for them to take their sale or their investment, you know, presentation and throw it in the garbage and start to talk to us about what they really care about, which is their culture and how they use their culture to try to do all the things that we're hoping to see them do. And we can talk about that in detail if that's something that's important. But one of the things that's important is that top line right there, integrity, trust, and humility. We've lived with this company for the last 8 years?
2015.
7 years. And so we've talked to them, we've met with them before. This is not the first time we've flown down there. We've followed them, we listen to every conference call, we listen to every presentation, we shop at their stores, we talk to customers, we talk to employees. We do all of these things that you might call scuttlebutt to try to figure out as much as we can about the company. And so we're there, we know that we think we can trust them. By the way, when the pandemic hit and they had to close all 90 of their stores, they didn't fire anyone. They closed all 90 of their stores, they trained people, they put a ton of money into training, they put a ton of money into improving systems, they put a ton of time and energy and employee energy into developing online commerce, because they're a store that they love to have you go into their store. They call it Air of Excitement. It's their retailing theme. They think that if you go into their store, you're going to want to go back time and time again because it's so cool. Well, now they have to translate all that to online shopping. It's super difficult. They did a phenomenal job of it. And because they didn't fire, they didn't have mass layoffs like a bunch of other retailers did, their stock got crushed during the pandemic, which is why Matt was like freaking out on the plane, because we're buying stock at, I think, what was it, like $2.90 or something like that. So we're buying stock at $2.60 a share because their earnings were atrocious, because they didn't, obviously they cut costs, but they didn't cut costs in a way that we would say would jeopardize their integrity. So they kept their integrity. We went down there, we met with these guys, they talked about what we wanted to talk about because that was what they wanted to talk about, and now all of a sudden we're their best friends. And that's what tends to happen when we've got a company that really acts in this way. They don't care about what their particular product is or what their particular 2-year strategic plan is. They care about how you treat people, how you develop people, how you put in place systems that can allow people to thrive. And when we talked about all that, they wanted to hear what we had to say. We wanted to hear what they had to say. So when we go to a company, our idea is not to try to evaluate them to see if they're up to snuff. Our idea is we want to learn from them. So we go in and try to learn. And if they want to talk about all the stuff that we care about, and we can actually learn a lot from them, that's a pretty good indicator that they're doing the stuff that we want to do. Well, the reason I'm talking about Andrew, and I keep looking at Andrew, is because those guys that are running a $1 billion company with 90 stores that have customer, what's the customer engagement metric that's like in the 99th percentile, wasn't it? Yeah, the customer satisfaction, there's some survey that they do, and it's a standard metric along, I forget what it is, I'll remember it at some point when it's not relevant. And these guys have customer engagement off the charts, and when Andrew was talking, the CEO of the company was like scribbling in his notebook, asking Andrew all about, well, what about this? Well, what about this? Well, what do you do here? Well, what do you do this? He's talking about a golf shop that sells, maybe a couple $100,000 worth of golf gear a year, and the CEO of the company is trying to take ideas from Andrew Flickema.
And Andrew accommodated him like nobody's business.
Yeah, totally. And you'll see, I promise you, you will see Andrew's ideas on the store floor at the Container Store. And for us, that is humility. And that's the idea that anyone can learn, that as long as someone, that one, you respect human beings for for all the talents that they have. They might not have the talent that you want them to have, but you realize that they have this talent instead over here, and then you try to learn from that. And that's the kind of work that we do. And so we had some questions about this guy's humility. He was a fairly new CEO. He came into this culture that was this robust employee-centric culture. He replaced a woman that we thought was phenomenal. And he came in and he had some very strong ideas for how he wanted to make the company better. And we thought that all of those ideas were great, and we thought that everything on that list checked off, but we were a little worried about humility. And then this guy is like, you know, trying to learn from us about how to run his business. That kind of thing over time adds up and helps us to develop an idea about what it is that we're looking for. And when we do that, you know, over and over and over again, we visit them now a couple times. We call them after they have their conference calls. We are, can I tell them what we're doing?
Yeah.
So this particular team at the Container Store, we actually are taking them to Herman Miller, now Miller Knoll. You know the company Herman Miller, most of you have seen that. That's the huge furniture maker that has a phenomenal culture, but also they do this lean thing Russ was talking about, probably better than anyone in the United States. We'll see. The last time I was there was 4 years ago, so it's been a while since I've been there. But what they do is out of this world, and we can talk about that if you want. I would love to talk about it. But we're taking these guys that have this Container Store team. The CEO and the CFO of the Container Store are flying with us. And Cliff, this fellow that Russ was just mentioning, that is the one other person on the planet that invests with all the same criteria. We're taking all of them to meet with the people at Herman Miller, at Miller Knoll, that are responsible for their production system. They call it their Herman Miller production system. And these guys, these people that we were worried whether they're humble, have agreed to come with us so that they can learn from Miller Knoll about how to do things more efficiently, how to get the most out of people in that environment, in manufacturing and distribution environment. They have a huge distribution center. They now have 2 of them, Container Store, and they're starting to manufacture more things in-house. So we're connecting now 2 companies, and we're going to sit back and learn from them. And when we do this over and over and over again, we really feel like we're starting to understand some of the nuances about how you can kind of quantify those non-quantifiable things in our system. I know there's way more involved in that question, and we can, again, take the conversation in whatever direction you want to go.
This is my last question. First of all, thanks for what you do, and thanks for doing this.
Thank you.
Yeah.
Thank all of you, by the way.
So how many companies do you own? 25?
30.
30? So is
Some.
it a target-rich environment out there, or are these the only one? I mean, I'd kind of like to know are you always looking for more? Do you have others on the radar?
Yeah.
Without tipping your
So
hand, so we don't go all online, but we don't want to do what you do.
actually, with the work that Jeremy and Dominic have been doing, the relationships that they're building with referrals to other companies, a lot of the work that Cliff's doing has really opened up. I mean, we've got an on-deck list that I can't even, we'll never even get to. It's just, it's exploded. And the hardest thing for me is trying to stay disciplined enough to keep working on these companies without actually owning them. And so we have, our on-deck list has probably quadrupled in the last year given their travels.
From
And
2 to
what they
8.
have done is is totally amazing. I mean, the fact that they could build a relationship with these companies where one company is willing to go to another company with them, I could have never done that. the work they're doing is at a whole nother level, and they've only been doing it for, I mean, they're just scratching the surface where this thing develops into, and the fact that they could go to these companies and say, you know, we've been working with Andrew at the ranch club, and we're having a hard time getting buy-in from folks on these issues, and you know, that they're actually doing the Gemba work, and that they convey that when they go visit these companies, they're looked at in a whole new light. Suddenly they're talking on a level set, and the relationships have exploded beyond anything I could even imagine. And literally, they're just starting this work. It's going to be really, the fun is really just starting.
I think there's a couple of reasons why. One is that we're somewhat younger, or seem younger, more immature maybe, than the folks we're talking to, so it's disarming to them. We're not normal investors. We're not, some, huge hedge fund manager that's coming in and going to rake them over the coals about what they're doing or not doing. We go in with the attitude that we want to learn, not that we want to preach. And we talk about the things that they really want to talk about. And yeah, we are starting to have more experience. Russ says that we're starting to become experts. I don't agree with that. I think we are in the very, very early innings of what we're trying to learn and what we can learn. And even when we feel like experts, it'll be we won't be doing our job anymore, because the idea is to constantly get better and better and better. And the best companies that we see are the companies that say, "Oh my God, we're just starting this." Like the best manufacturing company we've ever been to says, "Oh, we're in the second inning." What we've realized over the last 10 years that we've been doing this process is that we're dumber than we thought. And there's way more that we have to do now than we ever thought we had to do in total. And that was 10 years ago. And so, and we try to take that same attitude that we are constantly going to learn. Hopefully we continue with that attitude. But I think all of that put together makes these folks really want to talk to us and open up to us. They have a relationship with us that they don't have with anyone else. We were talking to the CEO and chief operating officer of a big company, much bigger company, in fact, this morning, and the guy at the end of it said, "Man, you guys don't ask the same questions that everyone asks. You're totally different than everyone else. You're totally unique. We love talking to you. Sometimes it's really hard because we have to think about things and talk about things that don't come easy, or that maybe we don't want to talk about. But you guys are completely different than everyone else that we know." And I think that's really, other than this company that maybe found it hard, I think for most companies they welcome it. They love to, when you're the CEO of a company, you don't really care what your next product is. You care about the people that you're managing, and that's what they want to talk about. Do you have anything to add, Dom?
I mean, yeah, the only thing I'd add is that visiting multiple times is kind of the key, because you can hear him say a lot of things, but then you go back and visit 2 years later and a ton of things have changed. You're touring the same plant you toured 2 years ago, and it hardly even looks the same. Then it's pretty easy to see what they talked about before kind of manifesting a couple years later. So,
by the way, there are 3 people in this room that we've taken on trips to see companies: Patrick, Andrew, and Nick. There's more that are going to go on trips. And we've also brought, there's a particular company, Manitowoc, I'm sure you all know it. We brought the Manitowoc CEO, CFO, came to Missoula to meet these folks. And they're coming to Missoula again in a month. They're going to tour Patrick's facility. They toured it once. They're going to tour it again. And that's also helpful to us to see how they do things. It just connects us with them in a way that we could never connect just by listening to a call. Calls are super helpful, but we can really go in depth a lot more. And we're just scratching the surface of doing this, which has been super fun and it's exciting. And by the way, since no one's asking a question at the moment, I'll keep talking. The money that we have used to invest in and buy these, what we call Gemba companies, are our own Front Street Capital's money, not investor money. We're doing it, and which is a good thing for you investors, because so far we haven't made any money. But at some point, I think we will. But it's and we haven't invested a ton of money. For us, it's been a lot, but we've invested because we want to learn. We know that eventually these companies are, and they're small. They're not, we're not investing in billion-dollar companies like that. We're investing in companies that you would maybe consider startups or at least growth companies. And we are investing because we want to see how these folks do things, and we want a front row seat. And we've learned a ton, and we hope that we're trying to bring, some of that knowledge and cross-pollinate and, help them out with what we know. But certainly we've received way more benefit from them than they have from us, which has been great. But it's, but yeah, I just wanted to point out it wasn't your money.
So it's 9 o'clock. I'm thinking maybe just offer anybody, people have been doing that, which is great. Anybody that needs to leave or wants to leave, anybody that wants to stay and keep asking questions, we'll stay here as long as there's interest. So
until Brandy kicks us out.
Yeah, I don't know what the curfew is.
Yeah, bathrooms are right through there, through that door, out through the breezeway, and you'll run right into them. Yeah, thank you.
Welcome back to Placid Lake.
Hey, brother.
So good seeing you.
Safe
guys.
driving.
This is great.
Yeah,
This is just
awesome, great, thank you.
Thanks, Gary.
Yeah, great.
Appreciate it, man. No, you're great. No.